Hey everyone, welcome back to Corporate Decoder. Today we're diving into a Form 8K filing, which is like a corporate oopsies. We did something important report. Get ready because this one involves some financial maneuvering that might make your head spin, but we'll break it down into plain English. It's got to do with borrowing money and how much that borrowing could cost the company and ultimately you, the shareholder. This report is dated March 17, 2025, so this just happened. The company we're looking at is Franklin BSP Real Estate Debt Inc. They basically lend money to real estate projects. Now they've just entered into a couple of new borrowing arrangements, so let's understand what they are. First up, Franklin BSP, through one of its subsidiaries, which is like a smaller company they own called FBRID REIT High Yield Securities LLC, signed a master repurchase agreement with JP Morgan Securities LLC. Now that's a mouthful, but what it means is they've made a deal where they can sell assets with an agreement to buy them back later. It's like a pawn shop but with bigger numbers. The important thing here is there's no set limit on how much they can borrow under this agreement and no set end date. That means there's a lot of flexibility, but also potentially a lot of risk. Next, they signed another agreement through another subsidiary, FBRID REIT, JU Seller LLC, this time with JP Morgan Chase Bank. This one's called an uncommitted master repurchase agreement. That uncommitted part is important. It means the bank doesn't have to lend them the money if they don't want to. This one allows them to borrow up to 250 2027, giving them some time to use the funds. The second agreement acts like a revolving credit facility. That means they can pay back the money as their borrowers pay them back and then borrow more as new opportunities come up. They plan to use these advances to fund new loans, including first mortgages, which are the safest type, all the way to mezzanine loans, which are riskier and higher paying. To make this second agreement work, another subsidiary, FBRID REIT Real Estate Debt OpCo LLC, has guaranteed the obligations of the borrowing subsidiary. Basically, they're saying if the borrowing company can't pay, we will. This guarantee agreement means the parent company is putting its neck on the line. These agreements come with strings attached. They include the usual promises and guarantees, but also require the guarantor to meet certain financial requirements, like maintaining a minimum net worth. This is like the bank checking your credit score and income to make sure you can repay the loan. Now, it's important to remember that the details above are a summary. The full agreements will be available in the company's next quarterly report, the Form 10Q for the quarter ending March. It will be released sometime after March 31, 2025. The report was signed by Jerome S. Baglan, who is the Chief Financial Officer, Chief Operating Officer, and Treasurer. That is a lot of responsibility. Now, let's put this all together. Franklin BSP has just secured more borrowing power. They have a flexible agreement with no set limit or end date and a more structured agreement with JP Morgan Chase Bank that could give them up to $500 million. They plan to use this money to originate or acquire loans, betting that they can lend money at a higher rate than they're paying to borrow it. The risk here is that if their borrowers don't repay their loans, Franklin BSP will have trouble repaying their own debts. Also, the fact that one of their subsidiaries guaranteed the debt means that the whole company's financial health is tied to the success of these new loans. On the positive side, having access to this much capital gives Franklin BSP the ability to take advantage of new opportunities in the real estate market. If they can manage their risk carefully, these new borrowing agreements could lead to higher profits. Whether this is a good move or not really depends on how well they manage their lending and risk. They have to be careful not to overextend themselves, and they need to make sure they're lending to creditworthy borrowers. It's a high-wire act, and investors should keep a close eye on their performance. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate decoding.